And we were just sitting here talking about some of the financing that's going on in the industry, and it doesn't seem like Moment right now. I mean, it doesn't seem like Moment's affected at all.
Man, Chuck, not only are we not affected, but we're growing. It's really a fun time. We came into the market a couple years ago and are growing through word of mouth. But really, Chuck, what we're seeing is all these other lenders where they're recoiling. We have the opportunity to bring in new programs. Just this month, Chuck, we have two new bank partners that are coming on board. And in this last month, we were able to introduce longer terms, 4 new products, and one of those includes an embedded second look program. So many are working with lenders who are tightening their underwriting right now, and we're actually being more generous in this time of need. So that's where we're seeing a lot of attraction into our platform.
With a lot of the information that we're getting right now, it seems like some of the lenders are affected. Can you kind of share? I don't want to, hear any like specific names, but what are some of the things that are going on in the industry right now that people should be looking at, but also being aware of that right now Moment is not, they're growing, and why can Moment grow and some of the others might not be able to do what you guys are doing? Let's put it that way.
I love it. So for that, let's kind of walk back to in a holistic view, what's happening? What's the uncertainty in the market? Why are we seeing so much change just in home improvement financing? And then I'll share with you kind of the levers that we have as lenders that you're going to see many of us pull throughout the time. So it all goes back to your prior video where you mentioned the Fed funds rate, right? That's the rate at which banks borrow money from the government, in which turn we can in turn fund your homeowners to move forward with the home improvement contracts, right? So if you look at the Fed funds rate just a year ago, Chuck, it was 0 to 0.25%. And today it's at 4.75. All right. Now let's put this in real simple terms. That's an 1,800% price increase, right? So can you imagine like your labor walking in, your $20 an hour guy, right? He's putting shingles up on the roof for you. He's cleaning up the nails. And he comes up to you and says, hey, Chuck, guess what? Tomorrow or over the next year in significant increments, I'm going to go from $20 an hour to $360 an hour, and you got to pay it because I'm the only guy in town that's going to put those shingles on the roof for you. What do you do? So it's a huge change. It's now that's to an extreme, man. But think about it. Like, what was the mortgage rates we saw a year ago, 18 months ago? The mortgage in my house starts with a 2. It's a phenomenal rate. Everybody said you'll never see that again in your lifetime. And hey, they're not wrong. When I looked today, you know what the national average mortgage rate is? It's over 7, close to 7.25%. So we've seen, that 4.5%, 5% increase of the Fed funds has been built into all of the interest rates. So we as lenders, that's our cost of funds, right? We have to go ahead and account for that additional price increase. And that's why you may see a change in dealer fees come along.
So right now, the only thing that may be affected when inside of Moment are the dealer fees. Am I right in saying that?
Yeah, so let's think about that. Like, what are some of the levers a lender could pull? And one of them, and probably the easiest one, is fees, right? If you know that your costs have gone up 5%, well, you need to be able to pass along to stay in business, right? You have to be able to make money off this, so that most of the lenders I'm saying have a change in their price, and that just makes good sense right now. Another lever that they could look at, if you're working with a lender who hasn't changed their fees, they might have looked at their underwriting model and said, hey, we're not going to approve as many deals. We're just going to cherry pick the ones we really like since our margins are significantly smaller. And there's several questions you need to ask whichever lender you choose to work with. And one of the first, if not the first, needs to be, what's your approval rate? Because what's the point in working with a lender if they're not going to approve your customers and help you win that business?
So true. It's, we see lenders all the time and we get excited, when we see that, oh, that they're a second look company. And that's my thing. And I'm going to be very blunt and very honest. When I hear that someone is a second look company, I don't get excited. The reason why is because I've used second look companies and they deny a majority of what they see. Now, granted, the reason why is because the only time you're going to send something to them is if it's bad. And so it's a very thin line as to whether a second look company would take something or not, but you still get really excited that, hey, you know what, I'm going to go and see how many of these turn downs I can get financed. What's going to happen to some of these second look companies inside of the current market?
Well, look, they have to get the money to lend you from somewhere. What's going to happen is it's going to be harder for them to find that opportunity. So they're going to have to say no more than others. And so when we talk about second looks, we're talking about a completely different lending model. A lot of those that focus on the second look space, their process is significantly harder than working with a first look like Moment. We offer the instant decisions, the soft credit pre-qualifications. There's a lot of value that comes with working with Moment that you're not going to get with a second look lender. They're going to ask for documentation you've done the work. They're going to require documentation from your homeowner. It may take a couple days for them to reach a decision. They're going to become harder and slower to work in today's economy. What we're also seeing into your earlier video was this risk-based model that you talked about. Chuck, I'm here to, there's only one way you should be using a risk-based model with the lender. One way, and we have it here at that Moment. It's what I call our milk money plan, right? It's because it's the payment 2% is our most popular fixed payment plan. It's a risk-based product. It's where your sales reps can go out and price condition as you do all that training along with 2% of the price. So if you had a $20,000 project, 2% of that's $400, right? So your reps can price condition that $400 and speak with confidence that that $400 a month is going to be delivered to your homeowner, irregardless of credit profile. If they're approvable at the Moment, they're going to get that $400. The risk adjust means your super prime credit, right? Those that are well qualified see a very low interest rate because they're well qualified. Those that are credit challenged going to see a little higher interest rate and maybe a longer term, but they're still getting that $400 that your reps got the buy-in on. That's the only way to use a risk-based model. If you're going to spin the wheel with a lender and just send them an application and hope they deliver an approval and not know what the product is, that is not how you want to do business. Chuck, that would be like you telling me you're going to put a roof on my house, but not tell me the color or the manufacturer or the warranty and install it and just hope at the end of the day I liked it and I'm willing to pay for it.
Totally understandable. And when you talk about that, just kind of helping a lot of the people that are watching to understand it is if it's at 2%, it can go less, but why not quote the 2%, then get them approved to find out what terms they get, but at least you know that the 2% is going to be there.
Exactly. We have what's called a multi-offer experience, and this is why Moment really wins in market. We know the 3 consumer behavioral types and how people choose to buy. Rather than asking sales reps to poke and probe and ask these discovery questions on if in a short period of time you have the ability to pay, you're a promotional buyer. If you need a low monthly payment, you're purchasing off of affordability. What we do is we put the buyer types all together so that our approvals will show multiple offers, and each one of those options is going to speak to a different buyer type. What we're saying is that your customers, they want a fixed choice with a promotion and installment. The payment factor plan we have a 2.5, a 2.5, and a 3% plan. What that's saying is we guarantee that monthly payment is going to be delivered. But if you choose to have another installment option, maybe like an 899 144-month plan, absolutely crushes in market today. That 8.99 rates beating a HELOC, which is a secured line of credit. that your customers had to go to their bank, spend their time, put hundreds of dollars down to open up this line of credit. We have that interest rate on a 12-year term that is a much lower payment factor than 2%. So let them choose. Hey, do I want that 2% I already agreed to? Or here's an option that's even lower. One of the key metrics, Chuck, to think about is, and to ask your lenders is, what's your approved to book rate? That's kind of the hidden gem. You know, when you look at KPIs of lenders, it's one thing to say, are you approving my customers? Yes, approval rate's important. But of those customers that are approved, how many actually fund transactions with you? And Moment has the highest KPI when it comes from approved to book, because we allow the customers to see options and pick the ones that work for them rather than guessing, let alone spinning the wheel and hoping that's the program that they want to have.
So I may be on dangerous ground here, but I'm going to say it anyway, or I'm going to ask it anyway, is any of the stuff that's happening right now in the market, is that affecting at all the credit rating approvals? I mean, I've heard in several instances that it's going to go from a 640 or 680 score to where now you need like a 750 score to get approved in many ways. Is that going to be the case with Moment?
Not with Moment, Chuck, and I'll tell you why. We are seeing that with many other lenders in this space. And the main reason we're seeing that is because those lenders have one single source of capital. So think about the 6 acquisitions that have happened over the last couple of years, where a bank came in and bought a fintech, a home improvement lender. Now that lender has one source of capital. They're beholden to their underwriting. So when you look at these large banks, they're very conservative. They have billions, if not trillions of dollars invested in their portfolio. Now, in an economy like today, they're more apt to go on a conservative route. They want to reinvest in mortgage-based products, secured products. Unsecured home improvement lending is a risk. So how do they adjust for that risk? They say either we're going to significantly increase our underwriting. So, FICO scores of only a certain percentage and above are going to be approved. Or in one case, we've even seen a lender who was capped. Previously, they were doing, this much money, and the bank they're working with now says your new budget is this. And they had to, unfortunately, tell many of their contractors they were unable to do business because that's what their capital sources say. With all that said, what makes Moment different is we're a modern platform that was built, and we understand exactly where that could be a detriment to have one single source of capital. We have several money sources behind us, from credit unions to banks to institutional money, meaning that we're going to survive. There's an appetite for your customers, and we have all avenues open to make sure that lending continues to flow.
And it's kind of on everybody's mind right now is Moment going to go into the solar space? The reason why I ask is I just had one yesterday, and he's freaking out about all the banking stuff and where the solar's at, and how a lot of the banks are telling him how he can make money and what he's allowed to charge.
Chuck, we can work with solar providers today. What we found is that our 12-year terms sometimes aren't able to get to that cost neutral position where the energy offset, the savings, are equal to the monthly payment. And so when we say solar products, we're usually thinking of those more along the lines of 20-year terms. So the short answer to your question is I would love to work with solar lenders today, but they need to understand that our 12-year term are probably the most comparable products for you today, selling the value of the solar system and not just the net neutral cost position. We would be a good fit for solar providers.
How does everybody get in touch, sees this and wants to get signed up with Moment? They still want to be able to give everybody those options that everybody loves to see and makes things a little bit easier in the house. How do they get in touch with you?
Chuck, I love our partnership with Top Rep, and probably the best way is if you could share our link. Persons, contractors who fill out that request form, come in, take a demo of our platform, see what we have. By being a friend of Top Rep, not only are you going to get reduced pricing, but you're going to get the ability to, work with Chuck and I more specific targeted strategies on selling and financing together, knowing that the Moment platform and Top Rep are aligned.
Awesome. Awesome. Man, thanks so much. I know when this thing started out, it was just a quick conversation and turned into a live and didn't really mean to, but you were talking so much gold. I just had to get this recording, and I'm glad that we did.